All right, option traders, we got the big grudge match today. Big face-off between two very bullish strategies. We got buying deep in the money calls versus selling deep in the money puts. I made videos on each one of those subjects a few weeks ago. Got a lot of interest in those. Got lots of questions too. So people really want to know which one's better. If you have a bullish position, should you buy deep in the money calls or sell deep in the money puts? So in this video, we're going to go head to head. We're going to check out both sides. We're going to do an example with a trade, and we're going to see which one comes out ahead. And of course, both of them have to be compared to buying 100 shares of stock, obviously, because each option contract has 100 shares of stock. So we're going to look at some numbers. We're going to look at a trade here, and we're going to look at the pros and cons and see which one's the winner. All right, so let's just get right into it. All right, everyone, Lee Lowell here from smartoptionseller.com. All right, so we're talking about very bullish strategies. Why do we want to talk about bullish strategies? Because look at the market. The market has had this nice V-shaped recovery. If you don't know anything about technical analysis, this is the stock chart of the SPY, which is the exchange traded fund for the S&P 500. And we know over the last 2 months or so, we had this huge down move due to President Trump's tariffs, and the market just really collapsed, but it bounced back really quickly, and that's what's called a V-shaped recovery. So everyone wants to start getting on board. They want to get bullish positions, so that's why we're going to keep talking about bullish positions. And the last couple of videos I made, very bullish strategies, option strategies, are buying deep in the money calls and selling deep in the money puts. Both very bullish. So we're going to go head to head and see which one really is possibly a better strategy and see if there really is an answer. Okay, so I'm going to bring up the cheat sheet here, and we're going to talk about buying deep in the money calls versus selling deep in the money puts. And we're going to look at an example here of using Apple, because it's a great stock to use, great options. And we're going to go little bit by little, and we're going to look at an actual trade here and see which one comes out better. So before we jump into that, let's just talk about what deep in the money is, so everyone's sort of on the same page here. Deep in the money options, whether they're calls or puts, are options that have lots of built-in intrinsic value, meaning if you were to exercise those options right now, they'd have a lot of value in them, okay? Versus an at the money or out of the money option that really doesn't have any intrinsic value. And the intrinsic value is the difference between the strike price and the price of the stock, and that has real value. So I'll go over this, and we're going to look at the option chain, but we're going to use Apple here. And let me pull up the option chain here so we're all on the same page, so we understand what that's all about. And in my opinion, a deep in the money has a delta of a 90. Okay, deltas range from 0 to 100, and what the delta tells you, there's actually a couple definitions of delta, but the most useful definition of delta is it tells you how much the option price will move according to how much the stock price moves. And deltas range from 0 to 100, and every strike price has their own delta. We like to choose these 90 delta options. 100 is the highest, but we feel that, or I feel that 90 is a high enough delta. So that means if the stock moves $1, that option price should move about 90 cents per contract, which is $90. Okay, so that's what the 90 delta tells you. If you choose an at the money options, and those typically have a 50 delta, that means if the stock moves $1, then the option price will move about 50 cents per contract, or $50. It's about half the value. Okay, so we're going to look at deep in the monies that have at least a 90 delta, and we're going to compare the cost and how much you'll get if you sell those, and what the risks are, how much you lose, and how much you make if the stock goes to certain levels. Okay, so we're going to figure out which one may be better. Maybe there's not a real answer. Okay, we're going to do this in real time here. So we're going to look at Apple. Here's the option chain: calls on the left, puts on the right, and we're looking at the November expiration, 188 days in the future. Now, if you're taking on a bullish position, you really do want to give the market some time to move in your favor. Choosing a 1 day expiration, a 1 week expiration, or even a 1 month expiration really doesn't give yourself a lot of time for the stock or the index to move in your favor. So I'm saying I'm more of a long-term person. I like to buy longer-term options because I want to make sure the stock moves in the direction that I think it will go. So for this specific example, we're going to look at a 6-month option. And what you do when you want to figure out how do you find the deep in the money 90 delta option? Well, when you have your option chain loaded up, make sure it has the delta column right here. Okay, so I have the delta column right here. So what you do is you kind of scan through the strike prices until you hit the 90 delta option, and then you see how much the price will cost based on the bid and ask. Now, Apple closed around $211. $2.25 on Friday, May 16, 2025. This is the aftermarket hours. There was, I think it was Moody's that downgraded the U.S. Debt rating after the market closed on Friday. So all stocks started falling off after market hours. But all these option prices are based on the 4 p.m. Eastern close, which was $211.25 for Apple. Okay, so you scan over. We're gonna key in on. I wrote up the cheat sheet, and I was using the 165 calls because I was looking at a different option chain, and that was the closest 90 delta option in the other option chain. So the 165 calls almost has a 90 delta in this case, and the option prices, we're always going to use something between the current bid and ask. So we're looking at $52.70 per contract. Right in between. Whenever you buy or sell an option, you want to try to do it in between the bid and ask. That's what's called fair value. So in this case, we're going to be buying this call option because that's a bullish trade. So we're buying a deep in the money call option for $52.70 per contract. And on the put side, we're going to sell a deep in the money put. So we want to go up to, and I looked at the 280 puts. Now the deltas here are going to look a little different because I think when the market's closed, and I think the broker here may be doing some stuff, tweaking their system after hours. So let's just wait until the numbers populate. But we are going to use the 280 puts, which are deep in the money. You see the stock price is 211. So the put strike is much higher than the current price of the stock. We're going to use the 280 puts. In this case, it looks like it's 100 delta. In reality, it's closer to about a 90 delta. And we're going to try to sell these things for about $68.70 per contract, or $68.60, I'm sorry, $68.60 right in the middle. And if you go back down to the 165 calls, we'll see that the strike price of 165 is well below the current price of the stock. So calls, when they're in the money, the strike price is well below the stock price. Puts, when they're in the money, the strike price is well above the stock price. So you have to understand how those in the monies work. Okay, so let's go to the cheat sheet here, and we're going to look at what we did. So we're buying the 165 deep in the money calls, and we're selling the 280 deep in the money puts. So let's compare the cost and risk and how much you can make and how much you can lose, and we'll compare it against the stock as well. So if you were to buy the 165 calls for Apple, you'll spend $5,290. That's $52.70 per contract. That's how the lingo is, but it's an actual cost of $52.70, $5,270 that you pay up front. When you buy an option, you have to pay for it all up front. So that's money that's out of pocket. And your cost basis is you take the strike price and you add the cost of the contract. So 165 plus 52.70 is equal to $217.70. So that is the cost basis by buying the calls. Okay, so it's a little higher. It's about $6 and change higher than where Apple currently is right now. Apple's at $211.25. If you were to exercise the shares, if you were to exercise the call options, your cost basis would actually be $217.70. So it's about $6 higher than if you just went in right now and bought the shares of stock. But remember, if you bought 100 shares of stock of Apple at $211, you're going to spend over $21,000 for 100 shares. In this case, your 100 shares via the call option is only going to cost you $5,270. Now, the good thing is that there's no margin requirement when you buy an option. You just pay for it up front. So there's your cost, $5,270. Now, when we sell the Apple 280 strike put option, you actually get money. Okay, even though it's a bullish transaction, you get money. You're selling the option. Okay, so you're going to receive $6,860 right up front. Let me just go back to the option chain and make sure the 280 puts. I want to make sure that we're looking at the correct dollar values here, the 280s. Okay, so $68.70 per contract. That's where we're going to sell it. So when you sell that option, you get the money right up front, and that money goes right into your account. So when you sell the option, you're not having a out-of-pocket cost. The money's coming into your account. So there's a huge difference right there. When you're buying the option, you got to pay the $5,200. When you sell the put, you get the $6,800 right up front into your account. Now, the cost basis is, if you get a sign on those put options, is $211.40. So how do you figure that? You subtract the $68.60 per contract from 280, and that comes out to $211.40. So your cost basis is basically right where Apple is currently trading at that time. So when you sell the puts, and if you have to buy the shares of the stock, your cost basis is a little bit better than the cost basis of the calls. Okay, so that's just knowing where if you were to have to get a sign on the shares when you're selling the puts, you would end up buying Apple for $211.40, which is pretty much right where Apple currently is right now. Now, we all know that when you do sell put options, you're going to have what's called a margin requirement, which is a portion of your free cash that's already in your account that's going to be held aside off limits for any new trades. It doesn't leave your account, it stays in your account. So any money that you have in your account on top of the $68.60 you'll get can start earning interest or keep earning interest because the money stays intact in your account. And I figured out if you have $6,860 in a 4% money market fund or a 4% CD for 6 months, if you're able to hold this trade all the way to expiration, you're going to get an extra $137 out of the trade. Okay, that's just how the interest works at 4%. All right, so if you're doing this in a margin account, which is what we like to do, brokers typically hold aside about 20% of what it would cost to buy the 100 shares. So in this case, it would be $21,000 to buy all the shares. 20% of that comes out to about, it's based off the put option strike price. So when you have to buy these shares of Apple at 280, you're paying out $28,000 when you get assigned. But you remember, you're collecting this amount up front. So your actual net cost basis would be the $21,140. And the 20% margin requirement is based on the strike price of 280. So 20% of 28,000 is $5,600. So if you have a broker that holds aside 20% as the margin requirement, it's going to be $5,600 that is held offsides, off limits for any new trade. So it's what's called the opportunity cost. You have $5,600 of money that you cannot put towards other trades. So that you can look at as an opportunity cost, but it's not an upfront debit that's coming out of your account. So there's another big difference between buying calls and selling the puts. When you sell the puts, the money gets into your account, the money's intact, there's no upfront debit. But you do have that margin requirement. So you have to make sure that you have that $5,600 at a minimum in your account ready to be held aside. So let's go through and also when you sell puts, there is that chance of early assignment, especially when you're selling deep in the money puts. There's a chance of early assignment, but you're playing with 6 months out. That chance of early assignment is pretty rare. So we don't really need to worry about that too much. But if you do get assigned early, you have to pay for the 100 shares, pay out your $28,000 at that time. But remember, you still receive the money up front. So your cost basis is still going to be $211 at that point in time. Okay. So now let's go through what the numbers look like at certain, if the stock moves to certain levels. Now let's take the worst case scenario that Apple craps out and goes to $0. If that happens, call option buyer loses the whole investment. They lose the $5,270. In this case, the puts will lose $21,140, and any stockholder is going to lose $21,125. So on the downside, worst case scenario, the calls are the clear winner. You have a lot less money at risk. You have like 16,000 actual dollars less at risk. So if you're thinking, if you're a defensive player and your worst case scenario, the calls are the better play here. Okay. If the stock closes at 165, which is the strike price of the call option, the calls will lose the whole investment because if you bought the 165 calls and the stock's still at 165 on expiration day, those calls are going to be worth $0. So the calls will lose, again, the full amount, $5,270. The puts will lose a little less, $4,640 when the stock's at 165. And the stock will lose $4,625. So if the stock closes at 165, the numbers are all pretty close, but in this case, the puts and the stocks are coming out a little bit ahead. Now, if the stock closes at 211, basically where it is right now, what happens then? Well, the calls are going to lose $670. The puts will lose about $40, and the stocks will be pretty much flat wash. So in this case, the puts come out a little bit ahead. Now, you can look at each number stocks. You can look at lots of different scenarios. So the numbers are going to change no matter what price of the stock you look at. You just have to, it's easy math. You just have to figure it out. Now, you're watching this, you can go back and you can go back and watch the video as I'm scrolling here. So let's look what happens when the stocks close at $280, which is the strike price of the put option. Okay. In this case, the calls will make $6,230, which is 118% return on investment. The puts will make, the most that they can make is the $6,860. Remember, when you sell an option, your gain is limited to the amount that you actually sell that option for. And the risk is unlimited to the stock falling to zero. So if Apple gets above 280 by expiration, the puts can only make as much as what they've been sold for. And in that case, it'll be 122.5% return on margin, not return on investment, but return on margin. The margin requirement was $5,600. If we make the full $6,860, you divide that by your $5,600 margin requirement, and here's your 122.5% return. And the stocks will make $6,875. That's a 32.5% return for the stocks. The return percentages are much lower because you had to put up a lot more money to buy those stocks to begin with. So in this case, the dollar amounts are almost the same. The calls and the puts in the stock make a little bit more, and the percentages for the calls and the puts are relatively the same. But once the stock gets above 280, that's where the calls can really supercharge your profits. I did the example at 300. The calls will make over $8,000 and 157% return, and the puts are going to stay exactly the same because they cannot make any more money than what they were originally sold for. So again, the puts can only make $6,860. Again, it's 122.5% return on margin. And of course, the stocks will make more money as well. And there's their percentage. So remember, when you buy an option, it has unlimited profit potential and limited risk. So you can see here, once the stock gets above 300, the calls will outperform the puts. But going from $211 all the way up to $280, that's $69. Is that something that Apple can do in the next 6 months? So one thing you can do is look at the probability calculator, which I'm going to bring up right now, and we're going to see what are the chances of Apple actually getting up to 280 in the next 6 months. And that'll give you an idea of what your probability is of maxing out on the puts if you sold them. So in our probability calculator, which we have on our website, and I'll talk about this after everything's done, I'll show you the services that we have. We're starting at $211, and here's the future date, and it's 188 days in the future, and we're going to use 30% as our volatility number for Apple. Okay, that just tells you how erratic Apple has been trading in the past, and based on its past movement, how often can it move about $69 in a 188 day span? Has Apple been able to move $69 higher or lower in a 6 month span? And based on how Apple has moved in the past, this is where we get this 30% number. And I'll show you where you can get that for free as well. So we put in $280 as our target in both boxes, and we click on go. And here's what you can see. There's a 90% chance that Apple will stay below $280, and conversely, there's about a 9.5% chance that it can get above $280 at expiration. All these numbers take into consideration what happens at expiration. Okay, anything could happen in between, but these numbers tell us the results at expiration. Okay, so if you're thinking, wow, there's only a 9.5% chance of Apple getting above 280, then I'm actually feeling pretty comfortable by selling the puts instead of buying the calls. Now, here's one thing that you can do. Actually, let me show you where we get the historical implied volatility numbers from. If you go to optionseducation.org, it's called the OIC. Open up yourself a free account, and you can look at the what's called the historical and implied volatility charts. Here's the actual price chart of Apple. Okay. Oh, this is the SPY. I'm sorry. Let's type. Okay, I typed Apple in here. This is where you type it in the box, and when you click enter, here's the volatility chart. So it's got the implied volatility and historical volatility numbers. There's two numbers, and you can see it was pretty stable over the last year until the tariffs came out and everything got a little crazy. Volatility went up, but now it's come back down to more normal levels. So both of them are under 40%. One's at 25.7%. The other's at 33.93%. So if we put in let's go back to the calculator here, and we'll put in about 30%, which is probably in between those two numbers. And this is the outputs we get, which is, you can see from Apple going from 211 to 280 in 188 days, there's about a 90.5% chance that Apple will stay below $280. Conversely, there's about a 9.5% chance that Apple can get above $280 in the next 188 days. So you have to figure out, is a 90% chance good enough for you to sell the puts? So that's something that you need to figure out. In here, if you were to sell the 280 puts and you're worried about having that capped amount of money that you can make, one thing that you can do is go ahead and buy yourself the 280 call for about $140. It's $1.40 per contract. That's an actual $140. So if Apple does get above 280, now you've bought this call option really cheap, that as long as Apple goes above 280, you're making money. You're making money with these calls. You make the max on the puts, and then you can start making money on the calls as long as Apple gets above $281.40. That would be the break-even point. So basically, the $140 that you'll spend could be that money that you make on that extra interest that you're earning on the $6,800 that you're getting from selling the puts. So there you go. As I said, there's tons of things you can do. Even if you bought those 165 calls, you can sell shorter dated call options against it. You can go out to June and you can sell, you can go up and sell yourself. Maybe let's look at July, get a little bit more money out of these things. You can sell another call option against it, maybe the 260 call, and get yourself $33 out of it. And if Apple doesn't get above 260 by July, those things will expire and you'll hold on to your deep in the money calls. So there's lots of things you can do, but we really want to look at, the one of buying one deep in the money call versus selling one deep in the money put. So let's go back to the cheat sheet here one more time, just kind of finish up here. So the pros and cons, of course, with the calls, you have limited risk on the downside. That works great for you, and unlimited reward potential. You have to pay the money up front, but you'll have a little slightly higher break even or cost basis by buying the calls. With the puts, you don't have any costs, but you'll have that margin requirement. So you do have to have money held aside. Call it an opportunity cost in this case. And you can earn money, you can earn interest on that premium that you've collected. Now, there's a chance you can get assigned early when you're selling in the money puts. So you have to remember that. So if you get assigned, you're going to have to pay the $28,000 for the 100 shares. But remember, you've taken in a good amount prior. With puts, they can be assigned early, as I said. Now stocks, same thing. Unlimited risk down to zero and unlimited reward. And for stocks, you have the most out-of-pocket cost. All right. So is there a clear winner here? Probably if you're leaning towards buying the calls, that there's a lot less risk on the downside and you have unlimited risk on the upside. It's just whether Apple can move that far, or whatever strikes you choose. In this case, it's $280 is that threshold where the puts won't make any more money. So if you think Apple can really get up and above that strike price of the puts, then maybe buying the calls is better for you. Conversely, selling the puts, you're taking in that money, you're earning some extra interest, you have no out-of-pocket costs, although you do have the margin requirement. So it's just really, what's going to work better for you, okay? And then also, once again, you can just go out there and buy the shares if you want, but it's going to cost you the most amount of money. So is there a clear winner? It's still kind of up in the air. I like to sell puts. That's the thing that I like to do. But if you watch my videos for all the years I've been making these videos, you know that the only option buying strategy that I like is buying deep in the money calls. So it depends on the situation. I think both options are great, but probably the deep in the money calls could probably get you more, especially if the stock really starts to move. Okay, so that's it. Don't forget, you go to optionseducation.org. Also, the other thing I want to show you is you can use the options calculator. I've talked about this, showed this before. At barchart.com, they got a free option calculator. It can show you, where the option prices will be at that expiration date. Now, we know when the stock goes up, the call option values will go up too. That's how you make money. But when you sell the puts, the put option value will go down as the stock goes up. So that's how you make money when you sell puts. Okay, if you sold that put for $68 a contract and the stock goes up, now that put option goes down to $58 a contract, $48 a contract. So you can always buy those put options back cheaper than what you originally sold them for. That's how you make money when you sell puts. Now, let me just show you here. Let's look at the puts here, and we're going to look at the November, okay? And we're going to look at the 280 put. And you can see it's trading around $65. So let's just bump it up just to make sure we're all on the same page here. Let's change the volatility to 30%, maybe 35%. Okay, how about 37%? Okay, so there's the option price. The value is around $68.70 a contract, which is what we were talking about. Now, on expiration day, we're going to take this all the way down to 0 days, and we're going to bring up the price up to 280. And you can see now there's no value. And now even if we do it on 1 day, so you can see a little bit of value, it's worth $2.50. So if you sold it for $68 and now it's worth $2.15, you've made $66 per contract, $6,600 right there. That's how you make money when you sell the puts. All right. So I hope this has been helpful. Got a lot of questions on both strategies. You want to know which one's better. I hope you can kind of make a decision on your own. You can go back and look at the cheat sheet again if you want. But I'm on the screen. I'm going to put both of those videos that I just made recently, the one on buying deep in the money calls itself and the one selling deep in the money puts by itself. And I'll put links down in the description below as well. Lastly, give me a thumbs up, give me a like, leave me a comment. If you found this video helpful, let everybody know. Send me an email, I'll answer your emails. Also, read down in the description below. I've got links and books and other websites that will be beneficial for you to help your option trading game. Let's go to our website real quick. smartoptionseller.com. This is where the probability calculator is here. Right under our services, we have our newsletters that we run. We're all about selling put options. We have a probability calculator here, our one-on-one coaching. And if you know nothing about selling put options, get our free ebook. Click here. It'll bring up the page for the ebook. Put Selling Basics is what I wrote. Scroll down, put your name and email address here. We'll send you an email back with a link for the book. Okay, we have our video series. If you want to look at that, we have our Warren Buffett ebook. That's check out. If you like the deep in the money calls strategy, look at the Warren Buffett ebook. All right, that's it for me today. I hope this has been helpful. I will see everyone in the next one. This is Lee Lowell signing off.